What's up, everybody? It's Brandon Locaron here, and today I want to talk about a conversation I was having with a friend of mine actually last night. And the question became like we were sitting around the dinner table and we were talking about real estate investments, and I was like, we were talking about Dave Ramsey and how conservative he is, and I was like, he's conservative, and he's like, yeah, but my friend was like, yeah, he's right though, and I'm like, he's like, because banks are terrible and whatnot, and I was like, yeah, I get that. That's a Dave Ramsey view. However, when you look at the real world doesn't truly function like that. And this is not a knock on Dave Ramsey or anything like that. I believe like in some of his teachings, like I do think like it serves a specific purpose for a certain type of people that need to overcome debt, need to pay off debt. But he doesn't believe in leveraging is the general consensus, his general belief, which I absolutely disagree with. And I'm going to outline that for you guys in the view of real estate and why you should leverage. And I'm not saying to go out and be a fool and be an idiot about it. However, if you do smart leverage, it could actually work more so in your favor than if you were to, just save up money and buy things in cash, right? So the topic we were talking about then was, I asked him the question finally. I was like, hey, if you had $500,000 today, right? You had $500,000 in cash. Would you rather go buy 5 properties, put down 20%, or would you rather go buy one property for $500,000? And he obviously said the $500,000 single property option. And I was like, why, dude? And he was like, well, it's safer. And I don't disagree with that. If you feel like you want to go along the safe route and do that, that's fine. However, I don't agree with that, right? Like, and yes, it's safer, but it does cost you time. It's time that you're not even guaranteed on this planet. We don't know when God's going to take us home, right? So ultimately, you have to leverage your time, leverage the money that, truly is there for us to use, right? Banks exist so that we can use. And in the great words of a mentor of mine, he says, it's cheaper to leverage the bank's money than it is to leverage my own money. So it's cheaper to borrow money than to use my own cash and save up for it, because not to mention I have to save up, I have to wait time. There's so many aspects that go into it rather than me not using the money that I have to leverage things. So I recommend leveraging things. I'm going to go through here and tell you guys why it's important to leverage. And I'm not saying go out and, if you own a landscaping company, go out and buy 10 mowers and you only got one truck. Like, that's not going to work, right? So I want to go through here and give you guys the example of exactly what my friend and I were talking about and some of the topics, because we played this out. And our wives were just sitting there looking at us like, are they really doing math right now? It's like 9:30 at night and we're having dinner and they pulled out the sketch pad, drawing houses and writing numbers and doing calculations on the calculator, right? So I wanted to talk to you guys about that and show you guys my point of view, as well as also explain his point of view as well, right? So first of all, the reason why I believe it's better to buy 5 houses at $500,000 each, but leverage and borrow money from the bank, put 20% down, put $100,000 down on each, is because now instead of you controlling a single house at $500,000, you control $2.5 million in real estate. So right there, it's already exponential. You're a winner. You're a winner by controlling that much more real estate. And the reason for that is because now you have the upside of the market growth. You see, real estate works differently than stocks do and gold does, right? So for instance, if you own, $1,000 or $100,000 worth of gold, you have to own that physical product. You have to own that physical product in order for it to go up in value, right? So if you were to go out and buy $100,000 in gold, you would need $100,000. However, if you were to go out and buy a $100,000 investment property, you only need $20,000, right, for a 20% down payment. But you actually control that $100,000 asset. And guess what? You, as the investor, makes money on the $100,000, even though you've only got $20,000 in that property. So let's say the market goes up by 8%, you're going to see your net worth go up by 8% on $100,000, not the $20,000 that you invest. You see what I'm saying? If you were to go take that $20,000 and buy gold, then you only have $20,000, and then gold goes up by 8%. It's only 8% of the $20,000. I hope you guys are following me here, right? So that's what I'm talking about. It's like, why would you really devaluate from a moral perspective real estate in order to fit something that it was not necessarily created for, that the system was not created for. Because I can tell you guys, as I'm getting into this fund space, as we're raising capital, you realize that it's not just you and I as real estate investors borrow money from each other, but we borrow money from the banks. And guess what? Banks borrow money from banks, and funds borrow money from funds. So this system of that exists, yes, while it might be corrupted or skewed, or whatever you want to call it, it does exist, and you have to use that at times in order to build your wealth a lot faster than you would if you were to save up for it. Because we're not guaranteed, again, we're not guaranteed tomorrow, right? So we did the math on this, right? So he was like, I'm going to buy his house cash, and I'm going to save up all the money. We're like, this is a utopia. There's no maintenance. The tenants are perfect. You move out, move in. It's perfect, seamless, right? So it would take him about 6.5 years to save up to buy the second house. And that was crazy to me. And as you can see, like, as we go through, like, assuming no maintenance, no vacancy, and property values continue to escalate, well, that's another problem. And I'm going to explain that in a second here. But as you see, the timeline here of waiting 6.5, 7 years almost to buy your second property, the property values would have gone up by 8% every single year. So now, instead of buying a $500,000 house, then you wouldn't be able to buy a $500,000 house, the same house, for $500,000. It would be worth closer to, probably $650,000, $700,000 in 5 years, 6 years, 7 years, right? Do you see what I'm saying? So the cost of waiting is costing you money. I mean, and that's just opportunity in general. It costs you money. What is it costing you to just sit there and wait? Right? It's costing you time. And time, whether we do, whatever you want to do during the 24 hours that I have, is the same 24 hours that you have, right? So whether you stay up late at night watching Netflix, or whether you go out, mow the grass and do some work on your side hustle, we're all given the same 24 hours in a day. What we do with it is different. And that's what separates us, right? So one of the things I like to talk about is leveraging the debt allows you to get higher returns. And the reason for that is because basically people make money on other people's money. It's easier to use the bank's money than it is to use your own, okay? So basically, remember that I believe you should leverage. I mean, if you feel like you want to go the safer route, then go ahead and do that. But we did the math, and in 30 years, it would take him 30 years to build a $30 million portfolio, assuming everything went correctly, right? So there you go. The other thing, too, is when you own multiple properties, what it does is it diversifies your portfolio, right? So what happens if that house that you have fully paid off, if it's not making you money, it's costing you money because there's maintenance, there's upkeep, there's utilities and everything that is included with that. So you have to diversify. And that's why I believe in owning a plethora of properties, owning multiple properties, because not only is your wealth continuing to go up at $2.5 million in control on your first purchase, it's also you're diversified, right? Your risk is kind of spread out, and you still have that equity. It didn't change your net worth, but it will change it after year one, right? So what you do is, essentially, like, you spread the risk by owning multiple properties. So if someone moves out, and yes, you could probably negatively cash flow in the beginning a little bit for 1 or 2 months. However, as you grow your portfolio, you'll realize that actually this is not so bad, and I don't actually negatively cash flow, right? So you actually increase your cash flow, because as a tenant moves out, it's easier to raise the rent versus you having to sit there on that single property. You can't raise rent until the tenant moves out. But if you have 5 of the same houses, right, and one tenant moves out after year 2 or 3, and the market moves up from 3,500 to 3,700, then what you actually do is you create more. You actually increase your cash flow. You see what I'm saying? So by diversifying and having multiple properties, you will control more money, and you will make more money in the long run, right? Not to mention, you're not waiting for somebody else. You're not waiting for 7 years to buy your second property. You already own 5. So you're already ahead of this person, especially with your net worth, right? The other thing, too, is the tax benefits, right? And I went over this with them, and he was like, yeah, but that's crazy. You can't, like, and I was like, dude, like, there's tax benefits to having a mortgage on a property. And you could do accelerated depreciation. You could do, You could do cost segregation study, and you could really depreciate what you owe taxes, like eliminate your tax liability, which to me, that is phenomenal. Like the tax code was written for two people, right? And it's business owners and real estate owners. And you can go through and read through the tax code and you'll notice these things. But it's written for two people, people like me and people like you that are real estate investors. So why not use it, right? So you have to use what's available to you. It's a tool. The tax code is a tool. It's available to everybody. I don't believe it's racist. I don't believe it's biased in any way. It is what it is, okay? And the wealthy people are doing it, so why shouldn't you? Instead of complaining about it, go do it, is what I tell people, okay? And the other thing too is, like, as you're building a portfolio, what you're able to do is actually go back and do cash out refinances. So I could go back and say, like, hey, look, I will, my properties are worth like, $7 million now. I'm going to go back to the bank and say, hey, give me 80% of this loan to value. They'll be like, sure, here you go. Here's your money. And I'll go out and buy more properties. And I'll go out and buy another 10 properties or 20 properties. And as you can see, this growth is exponential when you use the bank's money, because it's cheaper to use the bank's money than your own. So remember that your growth continues to go up, because when you're building a portfolio, it's important to use the leverage. Now, I'm not saying as you get older, you couldn't go back and say, okay, I'm slowing down. I don't need to really buy anymore, which I don't know why you would. I would go back and start, you could do what's called a debt snowball, right? Which Ramsey talks about. And that's something I agree with. Like, start paying off the first property, pay off the second property, pay off the third property, right? And now you can get them all paid off a lot sooner than that guy took to get $20 million in real estate. You're sitting on $100 million and you're going to have it paid off in half the time, right? So this is why it's important to leverage, and this is why it's important to leverage smart. I will tell you guys, don't go out there and buy really crappy investments. And I always tell my investors, I always tell our clients, investments are like a bus. There's another one coming around the corner, and everybody has a great deal. So make sure you hit that subscribe button below, like, follow, comment, and let me know your thoughts. Would you guys buy one property or would you guys buy 5? I'll see you on the next one. Take care.